Today on Trader Tip Tuesday, I want to talk to you about a concept that is really important, which is maximizing the benefits and the structures of your retirement accounts. So today I'm borrowing from a PowerPoint we did a few weeks ago from a presentation that we did. I want to talk about how you might turbocharge your 401k or your IRAs while reducing your risk. How about that? Wouldn't that be amazing? Now, small shifts can make a massive difference in accelerating your financial freedom. So your retirement accounts need to be a weapon for you to move to the life that you want. It's ironic that a retirement account is called retirement. Some of you want to retire, but for me, I don't want to retire. I love working. What we want to do is we want to work from a place of financial freedom, not retirement. We want to live a life that we love to live, not just go off to die. When I hear retirement, I think of being put out to pasture and just waiting to die. Anyways, that's my view. I want you to be able to be financially free. In the path to financial freedom, your retirement accounts are a key asset. So, first of all, when we look at a typical American, they keep their savings in really two places: the equity in their home and the equity in their retirement accounts. It's really interesting because people tend to only get savings when they put it away in some place they can't access. So you make your home payment, you can't get the money out of your house. You take deductions or get tax benefits from your retirement accounts, and it gets taken out of your check and it goes right into an account that you don't really see. Now, I'm not going to get into all the details of this, but there's several standard retirement accounts. There's a traditional IRA, there's the Roth IRA, they're two of the big ones. There's the SEP IRA, which is for really self-employed people. There's a simple IRA, and then there's the 401k. The 401k is the big one that really replaced pension funds. Companies used to have pension funds, but they got to be way too expensive for the companies. So they got rid of them, and instead they created a 401k, which instead of guaranteeing you what you'd get, what they do is they set it up in a way that you manage it yourself. So we have traditional 401ks and we have Roth 401ks. The simple difference between a traditional and a Roth is a traditional, you get a deduction on what you have to pay taxes on now, but you will pay it later. So it's really a tax deferral. You don't have to pay the tax now. You can take that money, put it in a 401k or put it in an IRA, and it can grow over many years. And then when you pull it out, you pay taxes. A Roth, you pay all the taxes just like you normally would without a contribution. You put the money in the Roth IRA or the Roth 401k, and it grows and grows and grows. And then when it's done, you take it out tax-free. So you pay your taxes up front and you don't pay taxes later. Now, the problem that most people have is that in the retirement accounts, they have mediocre performance. This is for a variety of reasons. So first of all, let's talk about who benefits from retirement accounts. You'd say, Chuck, well, it's obviously the saver. Well, it's not really true. We want to look at, why are these things in place? They're not just doing it to be nice. Of course, politicians love to buy votes, so it helps a little bit. But the reality is that these accounts are in place for firms like Fidelity and Charles Schwab and Vanguard, Franklin Templeton and BlackRock and PIMCO. These are fund managers. So when they can create a structure like a 401k or an IRA, then what happens is these structures are incentivized to have the administrator manage it, and they direct you to funds like this. So retirement accounts are a fee generator for Wall Street. In fact, this is one of the biggest sources of profitability for financial services. The plans are run by an administrator who collects fees. The fund choices themselves have their own fees. And the fees charged for these products tend to be much higher than industry standard if you were just investing in them on your own. And the government puts rules in place that are supposedly to protect you, but they really make sure that you cannot invest. They really make sure that you invest in products that are created by the financial industry. They don't really want you to have your own freedom of where you put your own money. So some of the problems with 401ks is they have limited opportunity for cash flow. We really believe in the concept of cash flow. It's hard to get cash flow in a 401k. Most of your offerings don't pay cash or interest, or if they do, it has a lot of risk. Because of this, we cannot benefit from the velocity of money. We can't put our money to work. So what ends up happening is people get benefits to put money in a 401k, but then it just stagnates there. 401ks tend to have a lack of liquidity. If you pull money out, you got to pay penalties. And because there's a limited amount of funds that are offered, most people in a 401k end up just tracking the market. If the stock market's good, the 401k goes up. If the stock market's bad, they lose money. There's a concept called modern portfolio theory, which is what most basic financial advisors use. And when you have a 401k, you pretty much are stuck in solutions that mimic like a modern portfolio strategy. So you're long stocks and you're long longer term bonds. It's kind of it. But you're long them and you're long them paying really high fees. There's a lack of transparency with 401ks. So when you invest in a fund, there's usually little knowledge of what that fund actually invests in. You're just given like 7 funds. You can maybe get a prospectus, but it's a lot of work to actually figure out what they put their money in. So many of the fund choices are terribly run funds. So we want to remember the big asset management firms, like we mentioned, like the Fidelities and the PIMCOs and the BlackRocks, they are marketing machines. That's what they do. They're not great performance. They're great marketers. Get your money in their ecosystem, charge fees. Get just enough performance that you don't leave, or get you invested in a structure like a 401k that you can't leave. So the other problems are there's a limit to how much you can contribute to a 401k. Another problem of 401ks is a lack of investment choices. There's no fund offerings for precious metals exposure or commodities, so you can't diversify away from stocks and bonds. Or if there is, it might be really bad. I'll show you an example in a moment. Another big thing, like right now, short-term interest rates pay much higher interest than longer-term bonds. So typically, the short-term interest rates are below long-term bonds, but right now, T-bills have been paying 5.5%, where long-term bonds are like 3.5%. So when you look at the fund offerings, you cannot get short-term interest rates like this. For example, I was just looking at a typical 401k, and about the best you could do is get 1.5% in short-term investment. That's like 3.5 to 4% under what the market rate is. The other thing is many of these funds have awful performance relative to their benchmarks. So typically the best a 401k investor can do is have 60% stocks, 40% bonds with high fees, something like that. So when we look at these funds, almost 80% of active fund managers underperform the index. And this is just an example of a fund that I was looking at in a recent 401k, and it's the Commodity Real Return Strategy Fund from PIMCO. Now you look at this and go, oh, great, I can get commodity exposure, I can diversify. But then you come in and you look at this fund, and this fund is nowhere near its peak high in 2008. In fact, it had a 68.5% drawdown over 12 years. Does this sound like the kind of fund you want to be rotating your money into? And when you look at it, well, I won't get into it. It just obviously is very poor. Now, if we move to IRAs, IRAs have a lot of trading and investing restrictions. You can't short stocks. You can't buy stocks on margin. You can't trade options unless it's a cover call or a married put or a collar. You can't trade FX or crypto. You certainly can't invest in real estate or buy businesses. And you're usually unable to trade futures depending on the structure. So the bottom line is our retirement accounts, even though the average investor saves a lot of money in tax advantage accounts, they often underperform the market and they're subject to all the market risk. And why is it? They underperform due to high fees and a lack of investment flexibility. Our big concern is that retirement accounts are going to massively underperform in the next 10 years. This is because you can only invest in stocks and bonds. And we see a lot of things going on right now that we think inflation is going to last for several years. There's a lot of structural issues in the economy that are going to make it very difficult for inflation to come down. Modern portfolio of long stocks, long bonds does terribly in environments of recession or during periods of inflation. And that's because it has no way to address these issues. You can't invest in commodities or metals or short-term interest rates. So we believe a major bear market is potentially being set up with prolonged inflation and on and off cycles, kind of like the 1970s. If you do not have proven protection in place for these developments, your portfolio could get crushed. We don't want that for you. So another issue is that retirement accounts are potentially facing attack. So politicians in Washington are trying to find ways to raise money, and they're looking at where can we go raise some money? And IRAs are one of the big things that are being looked at. So let's just talk about the possibilities. What if instead of dealing with all these restrictions and mediocre performance and just not paying attention because you can't do anything, what if you could contribute massive amounts of tax deductible contributions to retirement plan? What if you could maximize low tax rates now in case higher tax rates are you face higher tax rates down the line? By creating and funding the right structure, you'll be able to invest in whatever you want. You could trade in it. You could invest in real estate. You could invest in crypto. You could invest in precious metals. You could trade complex option structures. You could invest and trade with margin. You could protect your estate from lawsuits and creditors. And you could massively reduce the fees you pay. What if you could do all of this? Another thing is, many of you out there have multiple IRAs and multiple 401ks. What ends up happening when we have a lot of these is we end up having an account that has $30,000 in it or $50,000 in it. We don't pay attention to it. It just sits there. Well, that money is being wasted. One of our core premises is that every dollar we have must have a job. It's got to go to work and do something for you. We can't have $50,000 sitting there not doing anything. But because of all these structural issues, it's hard for people to do something. Well, what if we could roll all of it up into one account, make one trade, one investment, and it was automatically allocated to all your accounts? As we do this, we have our 11 principles for creating wealth through tax efficiency. One is we own our tax efficiency, but we hire an expert tax advisor. So that means you got to own your own plan, but you need an expert to help you. Second is your tax plan is one of the best investments you'll ever make. I see people clip coupons or go BOGOs or things like this to save $50, but they're paying $100,000 a year in taxes. Wouldn't it make more sense to figure out how to take the $100,000 and get it down to $75,000 than it would be going buy one, get one on a dress or groceries? Something at the grocery store? The third principle is we want to deduct expenses against the highest tax income and minimize expenses against the lowest tax income. 4, we want most of our life expenses to be deductible. 5, we want to focus on reducing the tax rates on all the rest of the income. 6, our optimum tax rate is usually from a blend of strategies, not a single strategy. 7, we want to seek to own nothing but control everything. 8, we want to maintain control of our tax structures. 9, we want to be an expert at tax efficiency in your niche. So if you're a real estate guy, you better know your real estate taxes. 10, all tax planning has a business purpose other than reducing taxes. And 11, don't like to hear this, but the better the tax benefits, usually the more often, the more complicated the rules. This means to get some of the best tax benefits, you're going to need an expert to help you guide your way through it. So to accelerate our financial freedom, we want to contribute as much as possible to our retirement accounts, knowing that we maintain flexibility in how we invest and we maintain flexibility in how we spend it. We want to trade and invest in the lowest tax structures. So if you're trading and you can trade in a retirement account, this is when you can blow up your retirement account, like massively increase the value because you don't pay taxes on it. So we want to trade and invest in the structures that have no taxes or low taxes. I'm going to skip over this for now. So I just want to show you this and then we're going to wrap up. This is one of the concepts we teach. You can create an LLC that becomes the primary investment vehicle for your IRAs, or your 401ks. This creates the flexibility to be able to manage your money yourself and direct it to whatever you want to direct it to within reason. It also builds a much stronger layer of asset protection in case there's ever a lawsuit, because it's in this other entity, it's protected. But this is one of those structures, you don't want to do this yourself. You want to make sure you do it the right way so that everything is done right. So there's no surprises. And this is something we can help you with. So this Freedom Accelerator is something that we are working with students on this month. I encourage each and every one of you to step back and look at how you structure your retirement accounts. This is big. I have a student I talked to a couple months ago, is 2.4 million in investable assets. That's a good amount of money. But he has 1.6 million of it in a 401k, in which he only has 7 investment choices. 7. So 67% of his assets are tied up in a shitty 401k. He needs to get out of it and rotate into something like this. And this would help him massively. So I'm talking to him about, because that 1.6 million, it could be invested in anything, not stuck in these 7 funds. And we do so at much lower fees. So where are you at on this? Are you maximizing the amount of money you can put away? Are you maximizing what you invest in? These are important questions to get right. So that's it for this Trader Tip Tuesday. Tune in next Tuesday when I continue to share tips like this with you that help you be able to perform at an elite level. Have a great week. God bless.